Could $1,000 really become $20,000 with the right small cap stocks? That's a 20x return. And I'm not going to tell you these stocks will do it, because nobody can know that. But today, we're looking at 3 highly speculative companies operating in some of the biggest potential growth markets of the next decade. Number 3, SERV Robotics. SERV. Let's start with SERV Robotics, ticker SERV. SERV is betting on something very simple. Why send a 2-ton car to deliver a 2-pound package? The company builds autonomous sidewalk delivery robots designed for last-mile delivery. And the scale-up is already happening. SERV ended 2025 with about 2,000 deployed robots, and by 2026, it had expanded to 44 cities across 14 states. Its platform also works with major delivery ecosystems, including Uber Eats and DoorDash. Now look at the growth. In Q1 26, SERV generated about $3 million of revenue. That's up 578% year over year and 238% sequentially. And management has maintained approximately $26 million of full year 2026 revenue guidance versus only $2.7 million in 2025. That's almost a 10x increase in revenue in 1 year if the target is achieved. But here's the problem. SERV is still extremely small. Its market capitalization was around $360 million in late July, meaning the market is already pricing in significant future growth. And management expects roughly $160, $170 million of non-GAAP operating expenses in 2026. So the question isn't whether autonomous delivery is interesting. It absolutely is. The question is, can SERV scale its robot fleet and revenue much faster than its expenses? If autonomous delivery becomes mainstream, SERV could have enormous upside. But if robot utilization, economics, or capital requirements disappoint, the downside can be equally dramatic. That's why I rank SERV as number 3. Number 2, Nano Nuclear, NNE. Now we move into an even more speculative story. Nano Nuclear Energy, NNE. The investment thesis here is not traditional earnings growth. It's about energy, and specifically, the potential need for reliable power for data centers, industrial facilities, and other applications. Nano Nuclear is developing advanced microreactor technologies, including its Keranos MMR. And there's an important milestone here. In May 2026, the U.S. Nuclear Regulatory Commission formally accepted the Kronos construction permit application for review. In June, NRC review activities officially began. That is important because nuclear companies don't become commercial simply because their technology sounds exciting. They have to survive. Engineering, licensing construction, testing, deployment. And NNE is still early in that journey. Financially, this is also very different from SERV. Nano Nuclear is not a mature revenue-generating utility. For the 6 months ended March 31, 2026, the company reported a net loss of about $15.7 million and used approximately $9.25 million in operating cash. But here's something interesting. At March 31, Nano Nuclear had approximately $197.7 million in cash and cash equivalents after raising significant capital. That gives the company financial resources to continue development. And this is where the 20x thesis becomes interesting, but also dangerous. If advanced nuclear becomes a major solution for future electricity demand, especially around high-density computing and AI infrastructure, the addressable market could be enormous. But NNE does not yet have commercial reactor revenue to justify treating that market as today's revenue. Investors are effectively betting on the company's ability to execute over many years. That's why I rank NNE as number 2. Huge potential, huge uncertainty. Number 1, Redwire, RDW. Now, my hedge pick from these 3, Redwire, ticker RDW. And there's a very important reason I put it ahead of SERV and NNE. Redwire already has a real operating business with real revenue and contracted backlog. This isn't just a future technology story. Redwire operates across space technology and defense, including spacecraft systems, autonomous systems, and other mission-critical technologies. And look at the Q1 numbers. Redwire generated approximately $97 million in revenue, compared with about $61 million a year earlier. That's roughly 58% year-over-year growth. Even more interesting, its Q1 book-to-bill ratio was 1.92. That means it booked nearly $2 of contracts for every $1 of revenue recognized during the quarter. And then there's the backlog. Redwire ended Q1 with approximately $498 million of contracted backlog, up from about $411 million at the end of 2025. The company also reaffirmed 26 revenue guidance of $450 million to $500 million. Now look at the strategic opportunity. Space is becoming more important. Defense spending is increasing. Autonomous systems are becoming more important, and Redwire is positioned across multiple of these themes. The company has also received significant contracts, including a $1.8 billion Andromeda IDIQ for advanced spacecraft, although an IDIQ ceiling is not the same thing as contracted revenue. So investors should not treat that $1.8 billion figure as guaranteed sales. That's an important distinction. Now, here's the risk. Redwire isn't profitable yet. In Q1, it reported a net loss of approximately $76.5 million, and free cash flow was negative $12.7 million. So, RDW isn't a low-risk company, but compared with NNE and SERV, I see a stronger combination of existing revenue plus backlog plus defense exposure plus space infrastructure plus autonomous systems. That's why RDW is my number one of these three. What would a 20x return actually require? Now let's address the headline. Could $1,000 become $20,000? Technically, yes, but that requires a 20x stock price increase, or approximately a 900% gain. And here's the part investors often miss. A company can't simply have a huge market opportunity and automatically become a 20-bagger. For that to happen, you need several things: massive revenue growth, a much larger addressable market, improving margins, enough capital to survive the growth phase, and critically, the valuation today must not already price in all that future growth. That's why I wouldn't buy any of these simply because someone says this could be the next 20x stock. Final ranking. So here's my ranking based on the combination of business maturity, growth opportunity, and strategic positioning. Rank 3, SERV. Biggest robotics upside, but extremely early-stage economics. Rank 2, NNE. Massive potential if advanced nuclear becomes a major energy solution, but commercialization and regulatory execution remain major hurdles. Rank 1, RDW. The strongest combination of actual revenue, backlog, defense exposure, space infrastructure, and autonomous systems. But remember, number one doesn't mean low risk. All three are speculative. A 20x opportunity can also mean a 50%, 70%, or even larger drawdown along the way. So if you had $1,000 and could choose only one, SERV, NNE, or RDW, which one would you choose? Put your ticker in the comments. And if you want more data-driven, small-cap stock analysis, AI stocks, space stocks, robotics, and next-generation growth opportunities, subscribe to Stock Market Analyst. Thanks for watching Stock Market Analyst. Stay informed, invest wisely, keep growing.